I guess in one way, good morning.
Good morning to you.
I guess in one way you could say this is a reminder that Europe still has an issue with its banks. But there's a more positive spin you can put on this story surrounding what's happening with Santander taking over Popular, and that is that the mechanisms that have been put in place are working. The ECB's been involved, the SRM's been involved, it's taken a view on the bank, it's said it needs to either be wound up or it needs to find some sort of private acquirer, it's written down the bulk of the assets, including the CoCos, including sort of what should be written down under the kind of structure that has been put in place. This is working.
I agree with you. I think this has been seen by the market mostly as an idiosyncratic event. It also happens in Spain, so we need a disclaimer there. Spain is a market where people have worked a lot on the banks.
Yep.
There's been an ESM injection of capital years ago, so the numbers are well known. There's growth. We shouldn't forget about that.
So that's the backdrop as well. So you can do this against that kind of positive backdrop.
Exactly. The backdrop for Spain with growth, low rates, banks being removed out of their systemic issues, I think set Spain in a very different light, for instance, to Italy. But I think, as your read is correct, this is seen as an idiosyncratic event, so not treated with the macro or systemic consequences. And we see that pretty clearly across the credit spectrum. Please.
But Francesco, European banks still have big problems ahead of them, even aside from Italy. I mean, the fact that they just don't make any money is a big problem, right?
I would agree with that. I think it's a global problem. It pertains to how people value banks under tighter regulations, capital needs, and with a low interest rate environment. But, I think if the outlook here is for curves to steepen a bit, for a reversal of monetary policy into 2018 across the US and Europe, I think the outlook for banks remains a positive one. And as I said, we see growth in Europe sustaining.
So is now the time, Francesco, to invest in banks, or has that time already passed? Have we kind of bottom ticked the banks here?
Look, I think position in European banks in particular has gone up a lot since the start of the year versus index. I think people are square or slightly overweight. I still see upside. I mean, that ties into our view of growth and rates higher in the euro area. But I think opportunities like this, where you have an idiosyncratic event taking the whole index down, should be seen as a buying opportunity. That would be my view.
Let's talk more about Draghi's view and try and figure out exactly how he's going to see the world right now. You talk about this kind of this gradual change that we're going to see emerging from the ECB. It may start tomorrow. It may start towards the back end of this year. But your sense is that we're pointing towards the exit right now. Do you think that can be started before the Italian elections?
Yes. I think the ECB will be careful not to get associated with political events. Obviously, they'll be looking at them for their systematic consequences. But as long as they remain local events, they will conduct monetary policy looking at macro indicators. And I think the macro indicators currently tell us that growth is strong, above potential. We're obviously coming from a very large output gap, so that's
takes a while to fill.
Takes a while. Credit has surpassed, I think, by a vast margin, their own forecasts at the ECB, so they're quite happy about credit origination. Banks are flush with liquidity, so all that is positive. I think where the problem still lies is on the inflation outlook, but it's again a global phenomenon. We haven't seen inflation.
Is that the wrong
really
metric for the ECB to be looking at? It's meant to be its metric, but is it the wrong one?
I think the unfortunate thing is that that's their needle in the compass, as Trichet used to say.
Precisely.
To the extent it forces them to do things that probably are not compatible with the overall mix of things. I mean, if they had a dual mandate, perhaps they would be talking a slightly different language. But having said that, I think that the QE is the net purchases, at least from QE, are going to be gradually faded. That's, I think, a market view, very widespread market view. Where I think the market is getting the message wrong is on the front end of the curve. We've seen taper tantrum in the US being a problem of a misunderstanding about the reduction of net purchases being associated with rate hikes are coming. And I think the ECB will be very careful not to let go of the front end of the curve. They want full control of that front end of the yield curve. And I think they have plenty of scope to achieve that.
Your colleague, Andrew Benito, put out a note on the 25th of May. To be honest, things have changed a little bit, but not by much. How are you guys positioned right now when it comes to the gilt market? How do you see the gilt market?
Well, what we're telling clients is that the gilt market filters in the fixed income spectrum as a very expensive market. It's been the case now for months, and it's a bit arcane. I think we put it down to the fact that when global rates have started retracing from the sell-off up to March, people in the UK still have a problem around the pension spectrum, the matching liabilities. And so there's an asymmetry in that risk. So when rates go up, people try to lock in rates. When they go down, there's an attempt to chase the market lower. So that asymmetry has probably created a dynamic, a very technical dynamic for the gilt market, which has made prices depart from fundamentals. Fundamentals look set to lift rates. I think down the line there'll be a hike by the Bank of England, particularly if we get more redistributive policies here. Inflation will remain a problem, and growth so far hasn't slowed enough. So the gilt market at 1% on the 10-year looks extremely expensive to us.
Doesn't it look like, Francesco, that either way you do get more redistributive policies? I mean, the Conservative Party isn't the Conservative Party you used to know.
I agree with that. I think across the aisles you have this narrative of redistribution, which obviously is the legacy of what we've been through the previous cycle. It's not unique to the UK. It's a problem that we see in many of the advanced economies, but I think it will dictate the profile for wages going forward, and taxation for that matter.
How quickly do we get back to talking about Brexit? Brexit seems to be the overriding factor. It's what moves sterling, it's what moves everything else. Is when you think about the gilt market, and you kind of segment kind of some of it's technical, some of it's down to kind of what's happening with the global macro theme and what's happening in the treasury market, and some of it's down to kind of idiosyncratic stuff surrounding the UK. Kind of piece the 100% together for me in terms of the factors that are affecting the UK market.
Well, I would say I would put it probably at 50-60% technical.
Right. So that's the majority of it. Right.
The majority of it, and then there is a global component. I mean, you have bonds at 20 basis points and treasuries at 2, so gilts can be easily at 1. So that's I think the remaining, I'd say 30%. And what is left, which is tiny, I think, is this Brexit idea. I think that is not going to go away. It's not that we have one party or the other taking government and then the Brexit situation gets revisited. I think it's just a matter of how long the transition or the softness to the exit.
But it's a small part.
I think it's a small part. That's
fascinating.
Francesco, here in Europe, we're all focused on the ECB, Banco Popular, the UK election, but it looks like the situation in the US is genuinely escalating. James Clapper overnight giving a speech in Australia saying what's going on in the White House is far worse than Watergate. What do you think this means for the dollar?
Look, I think the politics in the U.S. Have played into the dollar primarily by influencing people's expectations around the fiscal regulatory response by the new administration. There were high hopes that this response, this easing of fiscal policy would have come already in the summer or before the summer. And I think given the noise around the administration with all these issues that you alluded to, that policy shift is now being pushed out to 2018. And so we live in the context of low rates, growth being okay, no fiscal shock, and people just retrace. By the way, inflation has also been lower than expected. So it all kind of came together, leading to a flattening of the yield curve and a big appetite for receiving yield.
Well, let's talk about that flattening of the yield curve. So I got US 2s here. We're trading at 84.
Right.
How wrong is that number?
Look, it's. I've not been a big advocate of curve steepeners in my predicament about where rates would go. I think what is happening here is that at global level, people think that inflation is nowhere to be seen.
Yep.
There's technology, there's plenty of labor, a bunch of factors. And the realizations of inflation have proven them right so far. Wages a bit, more mixed, but on CPI, surely that's been the case. And at the same time, there is a conviction out there that the Fed is uncomfortable with keeping policy rates in real terms so low. So two forces are at play. The Fed is pushing up the front end, and the market is pulling down the long end.